launched just a few days ago. That's the Sundaram Multi-Asset Allocation Fund. It's coming at a time when multi-asset allocation funds are definitely in vogue. They've seen great interest in the year gone by and continue to be some of the top performers and attractors of fund. The idea is fairly simple. You hedge your bets in a sense. So along with a focus on equity, you have gold and fixed income too. What makes this one different, or what is the purpose or focus of this one? To speak more on it, I'm joined now by Mr. Sunil Subramaniam. He's Managing Director of Sundaram Mutual. That's the AMC, of course, that is launching the fund. Mr. Subramaniam, thank you so much for joining us and welcome to NDTV Profit. Great to have you here.
Hi, great to be here back on NDTV Profit.
All right, let's begin and get straight to it. Let's start by talking about this particular multi-asset allocation fund. Why a multi-asset allocation fund, and why at this point, when equities have performed phenomenally well, do you think they will continue to do so, or is this you looking at sort of risks increasing in the year to come?
So I think, first of all, this is an all-weather fund. So it's not that the timing at this particular time makes a difference, and I'll explain that in the next few minutes. So it's an all-weather fund. Why this launch at this time, and you've seen many other AMCs launch, is because in the finance bill last year, the taxation for commodity ETFs and debts was, indexation benefit was effectively removed. So any investor looking to hedge his equity risk with either debt or commodities could not do that in a tax efficient way. So multi-asset allocation funds, which can give you either debt-based taxation or equity-based taxation depending on the structure, started getting popular with investors and with distributors. So what Sundaram is planning to do is to launch an equity-oriented fund, which means that even within the multi-asset fund, we would have 65% in equities at all times. So thereby we impart the benefit of equity taxation. The second is that though the name is multi-asset allocation, we propose to make it as a fixed asset allocation, wherein we will keep the fixed income piece at 10% at all times. The reason for that is there are enough options available through aggressive hybrids, balanced advantage funds, where debt as a component to hedge the risk are available. But what our fund seeks to do is within the commodity space to maximize it, and within commodities we have chosen to specifically use only gold. At no time in this fund will have any other commodity other than gold. Now that's a very clear-cut demarcation from all other multi-asset allocation funds, because they tend to look at it saying we will choose the commodity based on our view, including overseas securities. We are not saying anything like that. We are saying our focus is clearly on gold. Now what is the logic of this gold? And we will keep gold at the maximum permitted 25% at all times. So these two significant decisions make our fund very different. And the logic comes from a very, very simple fact that gold is the long-term shock absorber for portfolios, because not only does it perform well when equities doesn't, it tends to actually deliver very good returns when equity is having negative returns. Now, debt generally varies between 6 to 8. So if you have shocks in the market, equity gives you negative, debt at least gives you 6 to 8. But with gold, it very often gives you double-digit returns when equity is correcting. That's one aspect. The second aspect, being an Indian and investing in gold, you get the benefit of currency depreciation, because, you know, over a long time, 3 to 4% is the average currency depreciation, and gold inherently carries that. So if you look at the rolling returns of gold as a standalone asset class through the MCX Gold Price Index over the last 18 years, gold has delivered an average of somewhere between 11 to 12% annualized as a return to the investor. So clearly, compared to debt and arbitrage, if you hold for the long term, there is an additional value of returns that gold in the past has delivered. We know that past performance cannot be predicted for the future, but since we use the rolling returns methodology to arrive at this, we feel that is fairly consistent in terms of its approach. So I think that's what differentiates the fund, and it's not that it's being launched because we feel equities are overvalued. We believe, given the inherent nature of gold to do well when equities doesn't, every equity investor in India should have gold in his portfolio. And hitherto, that was possible through gold ETFs directly by investors, but with the indexation benefit going away, multi-asset with gold is the best way for an equity investor to participate in the market at all times, regardless of whether equity is doing well or not.
Sure. And I know you can't give any predictive absolute return figures or estimates. That is not permitted. But if you can give us a ballpark sense of how you expect this fund to perform, that's part one. And second part is fixed income at 10%. Is that a good idea in a year where you're going to definitely see interest rates coming down? The only question is when.
Okay, so let me answer the first one. So in terms of, we all do back testing, we launch new fund offers. So our benchmark index, right, is 65% Nifty 500 index, 25% the MCX gold price or the gold ETFs, and 10% is the Nifty short duration bond index. If you take the performance of this index as a backtesting over the last dozen or so years, I think the fund has delivered roughly about anywhere between 8, 9, 10% on a post-tax basis. You will make that as at least better than fixed deposits because you get 10% equity taxation, right? But there are times when the fund outperforms. There are times when equity doesn't do well, gold does well. And there are times when equity and gold both do well. So in that sense, it's a good asset class to mix. And if you see point-to-point returns over the last 1 year, it's been 17%. I know again that past performance should not be predicted, but last year has been a good year both for gold and for equities. So such events also do happen in the journey. And remember that an economy goes through business cycles. And when there is recovery and expansion, equities does well. When there's contraction, debt does well. But when there is a slowdown, it's gold that does the best. And to answer your second question on in a year, is this a good time to keep debt only at 10? Like I said, for investors, if they feel debt is a good asset class, there are enough products available in the market through which they can trade. There are aggressive hybrids which are 70% equity, 30% debt. There are equity savings which have a little more than 35% in near debt. But that being said, I'd like to speak about this expected interest rate reduction. So I have a slightly contrarian view on this. I think during the current year, I do not expect a significant rate cut from the Reserve Bank in domestic terms. It is the Fed which is going through a massive rate cut drive. But remember, when the Fed hiked rates by 550 basis points, RBI raised it only by 250 basis points. So until Fed cuts it down by 300 basis points, there is no pressure on RBI. And look at the domestic scenario. Growth is not suffering, so you don't need rate cuts to support growth. Inflation is unlikely to drop below 4, given how prices are there of food and oil. So as long as it remains above 4, RBI really can't cut rates. So I don't see a scenario during the current year of a big rate cut in the domestic scenario. So from my point of view, for a domestic investor, right, I'm not sure that this is a good year for debt unless you're looking only at an accrual kind of return. I think equities is poised to do well, and gold also, I believe, given the international slowdown, the expectation of a rate cut by the Fed, and the fact that countries like Russia, Saudi Arabia, China, in addition to India, are shifting their exposure away from the dollar, and gold is a natural safe haven for them to park their monies. So I do think it's a sweet spot for both equities and gold in the coming year, and not necessarily that for debt.
Okay. Now let me just come to the equity part, because it's 65% of your portfolio, up to 65% of your portfolio is going to be in equities. And as I understand it, the focus is going to be more on large caps. Now, I know that's the theme, that large caps are the ones that are going to fire this year. But having said that, the phenomenal increase in mid caps and small caps don't seem to have ended yet. Can you explain the rationale behind that?
Yeah, absolutely. So what's happening is that the last 6 months or so, you've had periods in September and October when FIS pulled out money from India. And then from November onwards, they slowly came in, and December they came in a big bang way. So because FII participation has not been generally great except for the month of December, domestic flows have tended to be diversified, and there has been a buying by domestic fund managers has dominated the equity markets thanks to the strong growing SIP book and domestic flows. And hence, allocation by domestic fund managers has been focused on domestic-oriented stocks and sectors, and hence you've seen small and mid caps rally tremendously. From December onwards, with the clarity from the December 3rd state election results that the likelihood of the NDA government coming back to power, offering a policy continuity for 5+ years for a foreign investor, there's a significant change in outlook and approach towards India. This is strengthened by the fact that oil, thanks to the US lifting sanctions on Venezuela and Iran pumping more oil to finance the war with Israel through Hamas, you are seeing oil in flooded supply. So oil is also expected to be stable. One of the biggest factors for FIs to invest in India is a stable or a declining oil regime. With these factors positive, I do expect strong increase in FII flows, at least till the election. So given that, I expect large caps to actually outperform mid and small caps. Now, that being said, doesn't mean that small and mid caps are going through a correction, because as much as 30% of your 17,000 crore SIP book is in small cap and mid cap funds, another 30% is in multi cap. So roughly half of the SIP book is actually coming and helping domestic fund managers buy small caps and mid caps. So while large caps must be rallying because of the FIIs, domestic fund managers have enough fuel and ammunition through SIP book to support the mid and small caps. So I believe that the tilt is that large caps will do better. It doesn't mean small and mid caps are going to cover. So I think a multi-cap portfolio tilted towards large cap is the best allocation option. And incidentally, our fund is also proposing to be 75 to 80% in large caps within equities, and it will use 20 to 25% of mid caps tactically and strategically to allocate to enhance returns to the investor. So I think this is a good long-term strategy to adopt, given that multi-asset allocation funds are a part of the hybrid category, targeting moderate investors who want long-term inflation-beating and fixed-income beating returns with a low risk. And I think that's the key part that we've got to bear in mind. I can't afford to load mid and small caps in this fund, which is in the hybrid category, right? I've got to bear in mind what is the kind of customer who's going to invest in this fund, and I think playing the middle ground is the best for this fund.
Okay, so it's for those with a low risk appetite. Just a quick point of clarification. So no exposure here to REITs, InvITs or overseas equities?
You're right, absolutely. Zero exposure to either of those, all of those asset classes.
Okay. Just one point of view of the plethora of funds of this nature available in the market, and you addressed it briefly, saying that this is what stands out, but it is a bit of more of the same, isn't it? Why should an investor choose your fund over many that are available?
Yeah. So I think that, see, the general multi-asset allocation funds tend to tell the investor, trust me, I know when to put in equity, when to put in fixed income, when to put in gold, when to put in silver, when to put in other commodities, and leave that to me to balance it, to manage it best for you. We are at the opposite of the spectrum. We are saying we are putting it only in gold. You know that there's going to be 25% gold. So you take the call. So as an investor, as a distributor, you take the call. How much gold do I want in my portfolio, right? And I've already clearly laid out why we believe gold is the best commodity, because it's inflation protected, right, it's recession proof, it's currency depreciation positive. So, and hence, and it's a low negative correlation with equities. So we are saying we are giving you this product. It's a very WYSIWYG product. What you see is what you get. There's no confusion. So if you feel gold is going to rise, allocate more to my fund. If you feel gold is going to fall, you can take out money from your fund. So to that extent, we have actually said that up to 30% of the corpus, investors can withdraw without exit load. So we are making it very clear and free that from our side, we are a manufacturer who is going to allocate a fixed asset allocation. You take the call, but it's going to be moderate risk because gold is negatively correlated with equity, and hence it dampens down the fluctuations of equity, but still gives you a healthy, tax efficient return to the moderate investor.
All right, so the USP is gold. All right, thank you so much, Mr. Subramaniam, for speaking with us and joining us on the Mutual Fund show. That was Sunil Subramaniam explaining the rationale of this new fund. We're going to take a very short break, but on the other side, we will get in an analyst to understand whether this fund and others in the category are the best choice for you. Stay tuned. Welcome back. You're watching the Mutual Fund Show. We're now joined by Amol Joshi, founder of Plan Rupee Investment Services. Amol, thank you so much for speaking with us. Now, in segment 1, we talked about the new fund from Sundaram, multi-asset allocation fund. I want to get your view on this fund and the space. Do you think it's a good investment opportunity?
Right, Tamanna, hi. Thanks for having me over on the show. So yes, I would certainly think so. And most of the times we make this point with our clients. We have seen it for several decades. Most of the times investors who come to mutual funds think of mutual fund as equity-oriented instrument only. And that is certainly not so. 1 or 2 days back, mutual fund asset under management AUM data was declared. Mutual fund industry in India has touched 50 lakh crore, out of which pure equity is only about 21 lakh crore. So that's roughly 40-42% only. Remaining 12 lakh crore is in debt, and the remaining component, about 30-35%, is in gold, international funds, and various other ETFs. The point that I'm trying to make is Indian investor is still heavily dependent on traditional fixed income investments. Those are of the guaranteed nature, those are of the non-volatile nature, including fixed deposits, as well as PPF, NPS, and other similar instruments. The investor is still heavily invested. FD size, as we know, in India is probably higher than 200 lakh crore at this moment. So 4 times of the entire mutual fund industry. Where multi-asset fund comes into the picture is not everybody is looking at swashbuckling 12, 16, 18% kind of CAGR. Most of the times people want to preserve the purchasing power of their money. Typically, you just want to beat the inflation and then some. That's where the multi-asset fund actually comes into the picture. As Sunil, the previous speaker, explained to us, his fund, as well as most of the funds, typically try to maintain equity taxation over here. And if your fund ends up making a 9 to 10% kind of return on a post-tax basis, mind you again, within equity long-term capital gains segment, you still have first 1 lakh rupees capital gains exempt per person per year. So within that also, you have a significant amount of tax saving to be done. So if you make almost, if you're 6%, 7% FD for a 20 or 30% tax bracket person, while coming to your post-tax return is about 4.5%. If you make 8 to 9% returns on a post-tax basis from multi-asset fund with a reduced volatility because of the debt component, because of the gold component, I think that would be a right choice for many traditional investors in India.
Okay, no, so just a couple of follow-ups there, Amol. First on the Sundaram fund, because we featured the Sundaram's, the new offering, which is why I think we should have an analysis on that specific one. What differentiates it from others in that same space? Because there were, I think, some 15 launches in this category last year itself.
Sure.
What differentiates it? It's bet on gold. And it has a relatively higher allocation for gold. Are you comfortable with that? Do you think that's a good idea considering where the cycle is? And secondly, you're speaking about a conservative investor here at a time when investors have displayed their willingness to increase their risks and their appetite for higher returns.
That's true. Both of those are valid points. So first things first, I would say if you truly ask us how we build portfolio at Plan Rupee Investment Services, typically we are comfortable with 10% to 15% asset allocation within the overall basket. Now, Sundaram has taken this call based on their internal research, maybe some backtesting, of going whole hog close to 25%, 20 to 25% gold. If you ask me, that it's slightly over and above what we will be comfortable with. So that's my quick comment on the gold component. Coming to the second point, you are again absolutely right. Mutual fund SIPs, you make a point that investors have displayed their risk appetite or appetite to allocate additional assets toward risk. But you have to look at it from overall perspective as a total wallet share of the investor. The point that I made earlier, fixed deposit size itself is 200 lakh crore. Out of 50 lakh crore mutual fund industry, also you have about 12 lakh crore in pure debt instruments. And another portion, about 20%, is in hybrid funds. Within hybrid funds, also you have debt component going in. So investors are very investors make their choice very, very clearly. Sunil previously also mentioned a point that out of the SIP folios, SIP inflows, about 30-35% of inflows are going into high risk. Wherever investor wants to take that higher risk, investor typically chooses mid cap, small cap, or multi cap funds. But there is another class of investor, or within the same investor, there is a certain percentage of wallet share where investor wants safe, slightly higher than FD returns with a tax efficient nature, and that's where multi-asset fund scores very well.
So for investors looking to rebalance their portfolios for this year, and I just want to put that in the context of SIP figures and overall mutual fund figures, allocation figures which came in for the month of December, new highs there, new records broken.
Sure.
Even your SIP figures were at all-time highs, over 17,000 crores once again, second time in a row. Do you think this is a category they should be looking at when you're reviewing your portfolio for 2024? And if yes, how much of your entire investment should be in multi-asset funds?
Right. I would have been very happy if I had a fixed answer to say that you should have 25 or 40% of your portfolio in multi-asset funds. Yeah. But certainly that's not how we look at things. What we typically do is we take very by the book kind of an approach. Once you arrive at your own risk appetite, then you gel it with the kind of investment horizon that you have, whether you're accumulating money for next 5 years, 10 years, or something like retirement that is 20 years down the line. And once you make a portfolio, you actually choose the schemes and stay with them for one full market cycle. It could be 3 years, it could be 5 years. Now, if you take example of last 3 years, equity, large cap index, Nifty next 50, SIPs as well as point-to-point returns are in excess of 16 to 17%. Now, that would certainly skew your asset allocation. Now, let's forget gold for a moment because you are looking at investors' portfolio and not a scheme. Let's say you started with a 60-40 kind of an asset allocation. Now, within last 3 years, you also had debt funds delivering slightly suboptimal returns simply because the duration funds typically because interest rates were going up. In that case, your asset allocation instead of 60-40 would probably now look like more like 80 or 20 because your equity component has gone up. What we suggest investors, which is tax efficient also, you need not tinker with your asset allocation every week, every month, every quarter. Look at it once in a year. And if your asset allocation has really gone out of sync, then you rebalance the out of sync portfolio. So going by this hypothetical example that I gave you just now, probably 20% of equity allocation needs to be cut down. Now, when you cut down that equity allocation, you have choice of going to hybrid or asset allocation funds, multi-asset being one part of hybrid funds, or you have to go to pure debt. Now, if you are also bullish on India story, also bullish on equity market continuing their momentum, then I would say you have a choice of making probably 5 to 10% into pure debt and another 10 to 15% going into hybrid funds. If somebody were to put a gun to my head, I would say about 30% of your portfolio can be, or your total portfolio can be in multi-asset funds.
All right. So multi-asset funds definitely should be in your portfolio, and no gun to your head, but 30% is a fair figure. Obviously, you have to tailor this individually to your needs. Thank you so much, Amol, for joining us on the show, and thank you to all of our viewers who've come in today and tuned in to the Mutual Fund Show. We'll take a very short break, but stay tuned. A lot more coming up on the other side on NDTV Profit.
Markets continue to inch higher. The Nifty breaches 21,700 briefly. Sensex jumps 600 points. Broader markets mirroring gains of the benchmarks. All sectoral indices in the green barring media. IT and realty emerge as the top gainers while Z drags Nifty media lower. We told you first and it's now confirmed. Z says it is committed on its merger with Sony. Adds that article on Sony ending the $10 billion deal is factually incorrect. And a thumbs up coming in from OMCs after oil plunges as much as 4%. Saudi cuts oil prices to counter Middle East worries. And a stellar rally in Adani Group stocks. Their market cap hits the 15.57 lakh crore rupee mark. Good afternoon. Thanks for staying tuned to NDTV Profit. You are watching Large Trade. I am Harsh Saita. We'll quickly first take a quick check on markets. You're seeing the Nifty just below the 21,700 mark, around 0.4% higher. Absolutely nothing to complain about as we've reversed some of those losses that we made in trade yesterday. We're looking at broader markets largely mirroring the benchmarks. You're seeing good gains across Nifty mid cap as well as small cap. In fact, the Nifty small cap is up around 0.9% as we around 0.8% as we speak. The Nifty small cap 250, the Nifty small cap 100 up around 0.9% or thereabouts. You're looking at pretty much all sectors in the green. Let's quickly look at the sector chart if we can. The Nifty media is down around 2.3 odd percent. But other than that, across the board, it's a secular green. Let me also take it to the advance decline ratio, strongly in favor of the advances, I would suppose. That has been the order of the day. There you go. At least a 2:1 in favor of the advances where the advance decline ratio is concerned. Focusing back on the sectoral pack, let's look at two key sectors. One is the Nifty media, largely dragged down by Z. Of course, on the back of that Z news, Nifty media is trailing lower. But let's take a quick look at constituents. There you go. That's a much improved list from what we were seeing around half an hour or so ago. But nonetheless, you're seeing Z with a cut of 6 odd percent. Dish also seeing a cut of nearly 3.5% in trade today. So that one's in focus. Also, the Nifty realty. This one has been on a spree, the Nifty Realty Index, and that continues to be the case, except for just two constituents in the red. You pretty much have solid gains across the board. Godrej Properties, DLF, Oberoi, all of which are clocking nearly 3+% of gains. So therefore, Nifty Realty continuing to gain ground. That's been the story of the day. With regard to some specific counters which have been in focus, let me take it first to Bajaj Auto, 2% higher. Buyback continues to be in focus on the back of that. GMDC, more lignite production which will come through. Expect top line growth to come through, 6.5% higher as we speak. SBI Life 3+% higher. December numbers showing good growth. Fino Payments 2.5% higher. Applies for a small finance bank license. That one's in focus as well. Gensol, IRB Infra, solid set of numbers, 26% growth clock for the month of December, 10% higher on IRB Infra. So those are some of the names in focus for today. But let me quickly take it to Z. We have the latest updates on the Z-Sony deal. Sources had earlier told NDTV Profit that good faith negotiations are still on. Z has now come out and confirmed that they're committed to the merger. They've confirmed it to exchanges after BSE, of course, asked them for a clarification on that article with regard to the merger, and they've come out and clearly confirmed that they're still in talks. That deal is not off. Most analysts on the street also believe it's a win-win for both parties. You saw Z, the stock being beaten down in trade early on in the day. It's made a bit of a recovery, but not a full recovery. It's still trading down by around 6% or thereabouts. Let's also listen in to what Karan Taurani of Elara Capital, I beg your pardon, had to say about the impact on the stock in the case the merger talks fall through. Listen in.
The deal getting called off is too far-stretched in our opinion. We believe that there's a low likelihood of this happening because firstly, the deal is of equal importance for both Zee as much as for Sony because the landscape is changing. RIL-Disney deal is approaching closer. Secondly, we don't foresee that just because of one condition of, CEO norm or a condition by Mr. Puneet, we don't foresee that the entire deal would be put at risk because a lot of shareholders, investors are involved here as well, and his holding in the company as an owner is about 4% odd. So again, it's a very low likelihood event. We believe that at the end, eventually the deal will go ahead in favor of both the parties.
Right, NDTV was the first to break that. We are Tamanna who broke that news, and we will continue to keep you on top of it. So stay tuned here on NDTV Profit. But let's skip ahead. Major news update. Bajaj Auto announced that its board has approved a 4,000 crore rupee share buyback with shares priced at 10,000 rupees each. We have Tushar who's joining us with all of the details on that one. Tushar, take it away.
Good afternoon, Harsh. Thank you for that. So the Bajaj Auto stock jumped about 10% at the open today and has now sustained the gains at about 2% up at this point of time, imparting the company a market capitalization of more than 2 lakh crore at this point of time as we speak. So essentially, Bajaj Auto has approved about 4,000 crore share buyback. That's second in as many years, where shares will be purchased at rupees 10,000 a piece, which is almost a 40% premium to the current market price of the company. In volume terms, the buyback is 1.41% of the total number of equity shares, which is we see as analysts are saying it's a bit on the lower side. In value terms, the buyback is 16.33% of the total paid up capital of the company and is 14.49% of the free reserves as of March 31, 2023. What we have to now watch out for is the acceptance ratio of the buyback. So the total acceptance ratio is coming out to be 1.41. Again, it's a bit low on the lower end. That, according to our calculations, the retail portion has acceptance ratio of 3.90% and general at 1.27%. So if you are holding 100 shares of Bajaj Auto as of now, what will you get? You're looking at making up, if you tender, also remember this is actually a tender offer that the buyback will be conducted as. You are stated to gain at least 11,755 rupees if you have 100 shares at this point of time. You'll be able to you'll be able to tender 3.9 shares in the buyback. Now, there are a few concerns. First of all, the acceptance ratio is low. We have seen past buybacks especially by IT companies, which do it fairly regularly, which is at about 2 to 3%. We don't know whether promoter participation will happen or not, which is most likely that it will happen. The share had, now the thing is, most people are seeing that this is also a way to shore up the company's share price going ahead. You have to also remember that almost the share value has doubled since the company announced its previous buyback a year earlier. So essentially, a positive for the stock, as we have seen so far, but we have to wait for more management commentary on how this particular thing will pan out, and I think it should happen in the next couple of months or so. Harsh.
Right, a bit of a wait and watch on some of those metrics, but of course we'll stay tuned and we'll keep our viewers updated on that one. But let's shift focus onto some of the large trades that have happened today. Nykaa in focus on the back of a couple of large trades that have happened. We have Mahima here who's going to talk to us about what those trades are all about and how the stock has really performed. Mahima, over to you.
Right, Harsh. So as you rightly mentioned, couple of large trades. Yesterday also, Nykaa, there was a large trade that took place where 10.2 lakh shares were exchanged, and that call takes up to 0.04% of equity at a price of 177.4. Today also, 12 large trades have taken place in Nykaa, where these are worth rupees almost 32 crores. And if if we talk about the number of shares that were exchanged today, they stand at 2.6 crore, and the highest price at which the shares were exchanged today is at 191.25. If we talk about the stock performance, the stock has been up most today in 7 weeks, and the trading it's trading at a volume of 8 times its 20-day average, and the stock has been up 10% in 5 days, 9% in 30 days, and 22% in the past 52 weeks.
Right. Thanks for that, Mahima. But, from the bottom, we've seen Nykaa share price really surge. We've seen 50+% in terms of returns. Talk to us about two pieces here. One is, how has the Q3 performance been? And second is, what are brokerages now saying? Because you've seen a good bit of correction in the stock price. What are the views like coming through?
Right, so its Q3 business update came in yesterday, and if we talk about the business update, its BPC NSV growth remained robust at 20%. Its GMV growth was higher at mid-20s, and volume growth has been healthy and consistent. Nykaa Fashion also witnessed a strong growth in Q3 FY24. Now, we had two brokerages that are bullish on Nykaa. We had HSBC today on Nykaa, because of which the stock has been buzzing. One of the reasons why the stock is buzzing, it has maintained a buy rating and it has raised its target price to 250 rupees with an upside of 44%. The upside is huge, and it expects that the BPC e-commerce market will grow at a 20 to 30% CAGR in the coming years, and it expects that revenue will double every 2 to 3 years for the next 5 years for Nykaa. We also had a City note yesterday on Nykaa, which says that Q3 performance has beaten the expectation across BPC and fashion verticals, and it raises its estimates to 20% and 32% year-on-year in BPC fashion and NSV growth, and it also expects that Q3 EBITDA margins will grow at 6.7%. So overall, brokerage views are also bullish for Nykaa.
Very, very interesting, Mahima. So after that kind of a rally, we're still positive. Brokerages are still positive on Nykaa. So yeah, we'll keep our eyes skewed on that one as well. But let's switch focus from Nykaa to Narayana Hrudayalaya. Now, we spoke with the management. What they are seeming to suggest is profit is the last thing on our mind. That's the word coming in from Viren Shetty of the company. In a conversation with NDTV Profit, he explains how people with chronic diseases can be covered in the long term through insurance. Listen in to a slice of that conversation.
At this point, profit is almost the last thing on our mind. The most important thing for us is to prove to ourselves that this is something we can do. More health, less insurance. If you run it as an insurance company, obviously you're going to do things like deny people with pre-existing conditions, find any reason to deny a claim. But we are in the healthcare business, and we want to offer healthcare to all our customers. And we have a belief that even with someone who has a surgery, who has diabetes, who has a chronic condition, that condition can be managed. Now, it may be more expensive, it may require a lot more work, but that's what we as a hospital organization know how to do. And so if we're able to price it appropriately, we believe that even people with pre-existing conditions can be insured and taken care over long periods of time.
Right, that's the management of Narayana Hrudayalaya. Of course, they've moved into the health insurance space with an IRDAI approval that came through over the weekend. Stock in focus up 1% in trade today. But time to take a very short break. Stay tuned. We'll talk about more buzzing stocks as well as large trades on the other side. Stay tuned to NDTV Profit. Welcome back. You're watching Large Trade on NDTV Profit. Let me quickly take it to where markets are. Slight bit of cool-off seen on the Nifty. You're up around 0.2%. Nonetheless, again, nothing to complain about. With regard to where the advances, positive contributories versus negative is at, you're still seeing negative contributories on the Nifty being just 11. So 80% of the stocks largely positive that we are seeing. Among the top gainers, you have the likes of an SBI Life, an Adani Ports, a Hero MotoCorp, and Adani Enterprises, all of which are gaining 2.5% plus in trade. SBI Life on the back of the December numbers, and you're seeing solid gains because the December numbers were very, very healthy. 20% growth on the total premium front, which SBI Life has clocked for the month of December. Also, we had one quick large trade which I want to flag off is the likes of an NHPC. Very small with regard to the percentage or the quantum of the market capitalization, just 0.01%. But this is, of course, a government-owned entity, and therefore the free float is largely capped. I'm also going to try and pull out some numbers for you because this one has really run up over the last year or so. We've seen the stock going from sub 40 to where it sits currently at 71 rupees a share. It's always maintained a healthy dividend payout. My guess is it'll continue to do so, largely because of it being a government-owned entity. You're looking at good sales growth across the last 2 odd years of around 25%. But essentially what's really giving the stock a kicker is the fact that there's a huge shift towards renewables. And there's also a big positivity when it comes to they're virtually going to double up with regard to its power generating capacity, which will start to turn around or start to reflect on top line as well as bottom line going forward, and also generate free cash flow because incremental investments are lower. The balance sheet overall looks decent. There's roughly less than 1:1 debt to equity. So definitely that's one positive that one would want to take home. So that's NHPC for you. Quickly moving on, we also have the likes of a Brigade Enterprises, another stock that hit an intraday high as it inks a large trade by signing a memorandum of understanding with the Tamil Nadu government for 3,400 crore rupees. Anushi is here to break down the details for us. Anushi, take it away.
Right. So with Brigade, if you see, the stock not only did hit an intraday high of about 6.4%, it also marked a new 52-week high. So if you look at the volumes, that traded at about 2 times its 30-day average. This was on the back of the news that you mentioned about the company signing a memorandum of understanding worth rupees 3,400. But let me just break it up this for you. So there are 2 MOUs. One is for the Chennai Metropolitan Development Authority to expand a presence in Chennai with rupees 2,000 crore investment and setting up 2 high-based residential buildings in its IT belt. And the second one is the ELCOT IT and Digital Services Department's investment of rupees 1,400 crore to build commercial and residential developments over there. Now, if we go ahead, we still await for the Q3 business update for this company. But Motilal Oswal recently came out with a report on its Q3 preview, wherein they expect about 24% revenue growth and its margins touching about 26%. Also, they see about 39% uptick in its bookings for the upcoming quarter 3 on back of the 2 million square feet launch that they did in Bangalore. Overall, stock performance-wise, if we look at it, was the second highest stock performer in the Nifty Realty Pack by being about like 112% up in the past year itself. Just to end it on what happened last quarter, the average realization, if we look at, that was up about 9% on a quarterly basis at rupees 7,466 per square feet compared to 6,835 square feet in the Q1 of the quarter. And if you look at the pre-sales, that were also about 25% up on a sequential basis at rupees 1,249 crore. So that is all on Brigade for today.
Right. Thanks so much for that, Anushi, for taking us through some of those details with regard to Brigade. But our final large trade, we have in focus GMDC. which is Gujarat Mineral Development Corp. The stock is trading on high volumes, has reached an intraday high of over 11%. Nykaa is here joining us with regard to the large trade as well as with regard to what's keeping the stock buzzing. Nykaa.
Yes, so the stock did hit an intraday high of 11.32%, and the stock is up 19% in the past month and 23.41% in the past year. Now, volumes were at 3 times its 30-day average, and the total volumes did stand at 1.74 crores, and the highest volumes were at a price of 480. Now, the surge in price was on back of two developments. One was the large trades. There were 4 large trades, and the total trades were over 25 crores. Around 5.2 lakh equity shares changed hands, and the highest change in shares was at a price of 501 crore. And the second was the company has now received the environmental clearance to expand its lignite capacity. Now they are going to expand the lignite capacity at their Surkha plant, and the proposed expansion is to increase it from 3 million tons per annum to 5 million tons per annum. Now this expansion is going to drive substantial revenue growth for the company, and even for Gujarat state's growth as well, as GMDC does play a crucial role as Gujarat's foremost mining entity.
Right, thanks so much for that, Nykaa. That one's trading at its all-time high as we speak, of course up and away, GMDC, and a couple of positives coming through as well. But let me quickly flag off some stocks which are buzzing on the back of solid volumes. We have the likes of Johnson Controls. 8 times its 30-day average is what the stock's volumes are currently at. You can see the spike in the stock, 5% higher on the back of that. You have the likes of an Ashoka Buildcon as well, 7 times 30-day average volumes. And you're seeing the spike there as well, around 9.5% higher on that counter. Polycab India also, you have again roughly 7 times, along with Trident, if I can flag that off. But Polycab is down 9% or thereabouts. Trident also trading at around 7 times in terms of its volumes, up around 2.5%. Galaxy Surfactants is trading at around 6.5 times its 30-day average volumes. And another one, Borosil Renewables, also solid volume, 6.5 times 30-day average, that one as well, 7.5% higher on Borosil Renewables. So across the board, those are some of the volume buzzers that we're seeing. Let me quickly move on though, onto a market voice. We spoke with Malabar Investments, Sumit Nagar of Malabar Investments, on what lies ahead for the broader markets in 2024. We've seen broader markets do extremely well through 2023. And he's here to give his say on what's in store for 2024 for the broader market indices.
What we saw in the markets in 2023 was sort of rising this wall of worries. I think when we started the year, I think 2022 wasn't a good year, and there were a lot of worries that existed in the beginning of 2023. And slowly as they receded, the market sort of continued its climb up. If you look at today, I mean, we think the market is reasonably well poised, right? So on the one hand, you have many positives, right? You have economy that's doing well, it's sort of gathering further pace. You have interest rates that have probably peaked out and they will come down. Macros are generally good. Commodities are benign. So these are all sort of good factors for the market. But on the other hand, you also have this worry of valuations being high globally. Maybe some sort of correction may happen. You've had such a steep rise in interest rates. Something somewhere breaks. There's slowdown or recession that people have been talking about. So these are the things that are the cause for worry. But the biggest one is that the markets are always forward-looking, right? So last year, even as things weren't that great, as they started to improve, markets already moved up. So some of this positive is already priced in, right? So where does that leave us? We think that there's still probably further upside because, as you pointed out, the rally only started in the last 2 quarters of the year, right? Just to point out, right, in the 18 months that ended in March 2023, we saw a massive amounts of foreign capital outflow, right? More than what we saw during the financial crisis. And it's only since April that foreign capital has started to come back. And what has come back is only maybe 2/3 of what had gone out. Right, so there's still some of that capital has to come back, and probably more, right? Because, as you said, that India is becoming more prominent, people want to put more capital in. So these sort of flows have a momentum with them. They run for a period of time, and so that will likely continue for some more period, unless something big breaks somewhere. I think so. That's what you're seeing. But at the same time, I think the easy money of rising tide, raising all the boats, I think that's probably over. So now it will be sort of more selective. Wherever you see good performance, companies delivering earnings and cash flows, that's where you may see the upside, right? So that's our view on the market.
Very interesting take coming in, that one. But with that, we're completely out of time on this edition of Large Trade. From everyone who puts the show together, as well as myself, thanks so much for watching. India market close on the other side, so stay tuned to NDTV Profit.
There is a palpable fall in banks, which is leading the markets lower. Welcome to India Market Close. I'm Neeraj Shah. And look at the Nifty Bank. I think this is the culprit. I'm glad we're starting with this screen. But the intraday would be even more interesting. It's down about 100 points. But the chart will come up to your left in just a moment from now. And you will see how the Bank Nifty completely dragged the Nifty lower. Look at this. The high was 47939. The day's low is 47273. And we are at the day's low. By the way, at 47273, we are below that mark that everybody's talking about, which is 47,500. But a very sharp gash in the Bank Nifty, which is leading. And what could be leading this, by the way, just before we come to the mid caps and small caps, bring up the HDFC Bank intraday, bring up the ICICI Bank intraday, and in the similar pattern, we'll get to know why the Bank Nifty is doing what it is doing. Look at that sharp gash at 1677. There is serious, not serious selling, but a serious pressure from the intraday highs for HDFC Bank. And I think something similar could be witnessed in ICICI Bank as well. I reckon it's 938, still in the green, but look at this fall. So I don't know if Fin Nifty expiry has got to do something with this, but clearly there is some pressure on the banking stocks. Now bring up the mid caps and small caps and see what's happening there as well. The indices per se, and you will get to see whether this pressure is percolating into the broader end of the spectrum or no. About 1/3%. The Nifty mid-cap index started off about 0.8%. What about the small caps? That will come up on your screen as well. And while the Nifty and the Sensex are still about 0.5%, the small cap index from 0.9 is now up only 0.55%. So clearly, the market breadth, I reckon the advanced decline ratio would have come off a little bit from what it was for a better part of the trading day, right here on your screen. It's not a convergence, but you can clearly see some bit of a pullback here. Now, this could be technical in nature and short-lived. Let's wait and watch. Last piece, get up the heat map and show you what's moving and what's not on the Nifty. Still an overwhelming green, very little red. But what is in the red? FMCG, so Nestle, Britannia, the defensives, and banks which have brought the index lower right now in the last 15 odd minutes. And what's in the green? Well, autos doing okay. Life insurance companies, after that data that came out at about noon, all of them are doing okay, particularly SBI Life, which was anyways up and is continuing to march on. And the Adani twins, Port and Enterprises, doing very okay for itself as well. And Larsen and Toubro. So much as Tamanna, we started off with Nifty IT being the crutch in the morning, that is completely gone. And while banks are dragging the index lower, a slew of different sectoral names have come to the fore. Classic management, if you will.
And I reckon you're right, Neeraj. Fin Nifty expiry would have played a part in what we're seeing with the Bank Nifty. But a few sort of specific stories and stocks on our radar, and one of them actually stock of the day. I want to talk a bit about Z, that has seen more twists and turns, plot twists and turns in some of their very famous serials and shows. I wouldn't call it a stellar recovery, actually. It was at some point 3-4% down, but went as down as 9%. So a clarification from the management has come in, and yeah, it's not a stellar recovery at all, but a clarification from the management has come in that their deal with Sony is very much on, something that we had reported earlier on the day first on NDTV Profit, and that continues to be one stock which is seeing some wild gyrations. But apart from that, Nykaa has had a good day, and HSBC report, which we told you about in the morning, their target price is at 250 rupees, so 40% plus upside from current levels is what HSBC says. There's been a block deal as well.